got a lot of stuff going on here next 2 or 3 weeks. So determine whether we're going to be able to go up, go down, or go sideways or what. So.
Hey everyone, thanks so much for joining us. My name is Rachel with your Tech Talk Tuesday from MarketEdge.com. With me today is David Blake to let us know what's going on in the market. David, how are you?
I'm doing well, Rachel. Thank you. All right, well, came back last week and tried to put a dismal February behind us last week. We actually followed up with, I think, the worst week of the year with one of the best weeks of the year for the Dow Jones. And we started out pretty strong out of the gate on Monday. We actually had a nice rally the previous Friday when we got the PCE report. It came out to show a little bit of inflation had pulled back just a little bit, but we still had a little bit of choppy trading midweek. Kind of back and forth. We're still seeing the yields move up every time we get a little bit of inflationary report or one of the Fed presidents opens their mouth. The yield on the 10-year Treasury did nose above 4% either Tuesday or Wednesday last week. That seems to be a level that seems to induce a little bit more selling. Then on Thursday, we did have Atlanta Fed President Bostic. He came out and basically said that he was firmly in the camp that we needed a quarter point rate hike at the March FOMC meeting on the 22nd. And that kind of kicked off a nice little rally in the afternoon. And then we had the ISM Services Index came in on Friday, and that actually showed a drop in prices paid for goods, which is what we're trying to see. Between that, and we also want to see a pullback in the jobs data. And with that little bit of a drop in prices for goods paid for, the rate on the 10-year did come back below 4%. I think it went into the weekend at 3.96. The 2-year also pulled back. It landed around 4.86. So a little bit of a reprieve there. We did see crude oil prices nudge up during the week. That's basically on China's reopening. We're hoping that it stayed below $80 a barrel. That actually is something that may cause some inflationary pressures as China reopens. And we're trying to get this thing down a little bit, but we'll see how that goes. As far as leading the market higher, it was strength in materials, industrials, energy, communication services, and technology. Those were the sectors that led the market higher last week. While defensive sectors that had been outperforming, the utilities and consumer staples, they were the laggards last week. So we finished lower. And at the weekend and on Friday, we ended up on a positive note. That kind of kicked off March on a upbeat level there. Now, one of the things, we are going into a seasonally strong time. March and April are usually pretty good periods for the market. So this isn't real, out of the ordinary. Maybe we can get a little bit more, but that's been my opinion that we're probably going to be in a trading range, probably going here for another week or two before we find out what the market's going to do. As far as the technical condition of the market goes, it's steady last week. The Dow snapped a 4-week losing streak. I think the S&P 500 had been down 3 out of 4 weeks. So we kind of stopped the bleeding. The indicators are mixed at this time. The MACD, which measures the short-term trend gauge, it's still bearish, and momentum is neutral, but it is starting to improve. We just start to see the 14-day RSI start to tick up above or right around 50 on the different indexes. So that's a little bit of a positive. We also saw towards the end of the week, we saw some of the major averages regain some key moving average support or resistance levels, however you want to put it. They kind of fell down the week before. The Dow Jones was able to come back above the 100-day moving average, and the S&P 500 actually bounced off its 200-day moving average and came back and reclaimed its 50-day. So that's good. A lot of traders, professional traders watch these things for support and resistance levels. The fact that the S&P 500 came down, bounced off of that support level was the bulls as a sign that we probably have bottomed out in October. So that was good. And then we saw the NASDAQ briefly taking a ride above the 200-day moving average. And it came back midweek last week, and then it ended up back above that 200-day. So that was a positive also. So traders want to see the different indexes, stay above these key moving average levels. We also saw some positive divergence in the secondary indexes, which I like to follow. That would be the Transportation Index, the Small Cap Russell, and the Philly Semiconductor Index. They're outperforming the broader market, the major averages. That's usually a sign. You'd like to see the secondary indexes lead the market higher and lower. And we also, I noted that we saw the 50-day. Everyone talks about the golden cross, which is where the 50-day crosses above the 200-day. But then we also had the 100-day moving average cross above the 200-day moving averages on those secondary indexes, and that helps to confirm that the medium-term trend right now is bullish. We also had several sectors that are still trading above their 50-day. That's the financials, technology, communication services, materials, and industrials. So you want to, when you're looking to go back into the market at this stage, you want to make sure that you're buying the sectors that are leading, that they're outperforming a little bit. So if you look at stuff, you can go to our industry group, look at some of these different industry groups in those sectors and pick out the strongest stocks in those sectors. Now, underlying breadth last week was positive. We had the NYSE and NASDAQ advanced decline lines both moved higher. We did have a lot more new 52-week highs on the NYSE. NASDAQ had more new lows than new highs, but it was only about 15 by 15, so not too bad there. We did see investor sentiment get a little bit more overly bearish. It's been kind of moving up a little bit here with the bulls, but we actually saw kind of a big drop down last week in both retail and professionals. The American Association of Individual Investors, the percentage of bulls wasn't changed much, but we did see the percentage of bears jump up to 44.8, and that was the biggest percentage of bears we've had since the last week of December. And then as far as the pros go, we had the National Association of Active Investment Managers Exposure Index. That fell for a third consecutive week, and that 3 weeks ago the pros were 85% invested in equities, and that's fallen back down to 47.4 over 3 points. So they're pulling cash out of there, which when these things get a little bit to the extreme levels, they actually turn into contrarian indicators, because that means it's gone a little bit too far. And of course, in this case, if the pros keep cashing out in here, that's going to be a lot of money that they're going to have to put back in the market later on, which could fuel the next run. I mentioned last Friday that we have the FOMC meeting coming up on the 22nd. At that point, we were looking for a quarter-point rate hike on March 22nd. That probably is changing as I speak right now. But as far as the sentiment is the fact that it's getting a bit more bearish isn't necessarily a bad thing. It's something you want to watch when that gets to extreme levels. That's something then we can start to look at that as maybe an indication we want to go in or out of the market. As far as industry groups, as far as the strong groups go, coal, aluminum, steel, and diversified mining. Part of that is due to China's reopening, so you're going to see a little bit some of these more material type things going out the door. As far as ETF categories went over last week, it was mainly energy. The sector of the energy was up 4.5%. Commodity energy, basic materials, especially natural resources, and industrial sector. So again, a lot of that is due to the fact that a lot of investors here in the States are hoping that we're not going to have a hard landing as far as the economy goes, but that's kind of still up in the air. The market was mixed yesterday. Part of that was again, we just talked a little bit about the China reopening. And one thing that was a little strange, they pegged their growth at 5%. I think for the GDP. I think most investors were hoping that we would see that up around 7.5 to 8. So that was a pretty conservative projection by China. And also yesterday, we saw one of the indicators that people follow for a recession is the yield curve and the inversion of it. And the 10 and 2 yield curve is actually the most it's been inverted since 1981. I don't know how with rates still going up. I don't know how we will avoid recession. You may have to. We're going to slow down here at some point because it's the pace of hikes is what really jacks the economy. So I'm still very cautious. I think maybe we can get a little bit of a little bit of a bounce, or at least go sideways in here for the next month or two during these seasonally strong periods. Now today we had a quiet open until Fed Chair Powell came on board. He's giving testimony before Congress today, and it wasn't surprising what he said. There's a lot of people out there that keep hoping that the Fed is going to back off here, and we'll have a chance for the market to move higher and Rachel stop. But he basically came in here and he reiterated that rates are going to need to go higher for longer, and that fueled fears that we may get a larger rate hike in March, and that's again it's feeding recession fears. And the market didn't like it. As I was while he was talking, the market was down 400 points to Dow, and as I'm talking right now, we're down to 460. So the market's not liking it. Again, they just keep hoping that at some point, as soon as the Fed mentions something nice, it's like, hey, we're getting close, and we are. We're closer to the finish line than we are to the starting line. But it's still, you have a lot up in the air. The dollar moved higher today. That it wasn't good. And as far as the yield curve goes, we have the 10-year. 10 years actually not doing too much. It's at 3.95. But the problem was you actually went up to 4%, and then you backed off of that after he took a break at lunchtime. But you do have the 2-year note, Treasury note, above 5%. And that's causing some problems here this afternoon as far as the equities go. So it's been a little bit of a rough start to the week, and we'll see how we go from here.
Fair enough. In last night's daily comment, you said investors need to stay focused over the next 2 weeks. I imagine that's even more pertinent now, given the volatility with Chairman Powell. So since the market sold off this morning, based on his prepared remarks, what should our subscribers take from the market's reaction today?
You really need to kind of stay focused here over the next 2 weeks. And I mentioned that I wouldn't be jumping in here trying to front run what the Fed's going to happen or what the economic data is going. And by that I mean if we get some stuff where we see the numbers starting to show progress on inflation, then we'll start to move up and you can take some positions. But I don't think it's the time to take a position or buy different stocks and then get surprised where all of a sudden the market goes, okay, that's it. We have to go down. We can't stay here. We have to go a half. Now, as we came in here I checked with the rate that we're looking for as far as rates go right now. We've been pretty much accounting for a quarter point rate hike in March 22nd meeting. That's 2 weeks from tomorrow, actually, is when they announce it. But that's it's a 66% chance as we speak right now that we're going to have a half point rate hike now. That's up from just 30% yesterday, 31% yesterday. Yeah, we have 67.5% probability of a half point rate hike today. That's up from 31% yesterday and up from 9% just a month ago. So they're kind of building in the probability that we're going to have a rate hike, which the market is not going to like. And then they're actually some people are projecting up to a 25% probability that we could even get another half in 20% in May. But they are looking probably about a 60% probability that we'll get the Fed funds rate up to between 5.25 to 5.5 at that May 23rd meeting. So we're looking at probably most likely a 3/4 point hike here over the next couple weeks, and that's going to be hard for the market to make any kind of progress at all with that. Now, there's what we have to look at later on here. Now, Friday, because it was delayed because of the way the calendar fell, we will get the unemployment, the jobs report. for February. That really kind of shook the market up, stalled the market rally that we had in January when we got that last month. We showed like we were expecting, I think, like 100 or 200,000 jobs. It came in at 525,000 jobs. That's not going to cut it. Now they've cut back. They're looking. I think if we get under 250, you probably see the market kind of go flat. If we would get another jobs rate, and a lot of these jobs are coming up in the service sector. If we would get something up around 350, 400, I think you're going to see the market. We could see another pretty good sell-off on that. We'll have to wait to see on that. Okay, after that, then that's going to be followed by the CPI and PPI for February. That'll be coming up, so we want to see how that comes in. One thing the Fed, Powell did say today is they're not going to set a certain unemployment rate that they need to see it like at 4% or anything like that. So it's possible that just because we're going to see a lot of jobs created, that's not going to itself throw the market off. But be aware that that was a complete surprise last month, and I would say if we get anything above 275 or 300,000, you're going to see the market sell off pretty hard in here, and then we'll see how it reacts. Rachel, hold the S&P 500. Okay, we're just trying to hold 4,000. Right as we speak, we're here at 39.98, and 4,000 has been kind of like a little bit of a line in the sand. The actual what you want to watch is probably around 39.80. But if you're taking some notes on this, 4,001 actually is the 50-day moving average on the S&P 500 right now. We've bounced off of that right here at this 4,000 level today. If we would see a big break on that, then we might see the next support would be the 100 and 200-day moving average, which are pretty much at the same level, and that's around 39.40. So if we would cut back here, like say 39.80, 39.75, you expect to see it go down to at least 39.40. Go ahead and pull up the Dow Jones. We're kind of breaking the support here also. As you can see this over here, we did break. We bounced off. We came up yesterday to the 50-day moving average. We couldn't get through it, but we were above the 100-day moving average. You could sell off today, and again, we're down about 470 points as I'm talking right now. We are below the 100-day moving average and the 50-day on the Dow Jones, which is not good. We talked about this market trading being in a trading zone range. I think you can probably go down to about 32,500 on the Dow Jones. You want to watch that. If we go below 32,500, those that follow the CTI and our timing, the MarketEdge timing thing, that would extend the negative void on the market out for another week. If we stay above 32.5, then we may actually be able to go to a positive buy on the market. We'll have to wait to see how that plays out. But again, that 32,500, that goes back, as far as the low goes back all the way into November. And then on the upside, around 34,250, 34,400, somewhere around that is the upside of that range. So it's a fairly wide range. It's about 2,000 points, but the reality is that's where we've been trading from today all the way back into November. Let's take one last look at the NASDAQ. As far as the NASDAQ goes, right now we are above that 200-day moving average. Yeah, we're right above that 200-day moving average right now at 11.4 for the 200-day moving average. We could go down as far as that here. The 50-day moving average is 11,289, but it's got a ways to go here. We've still got another 175 points on the NASDAQ before we're going to start breaking that key support level. So we'll kind of keep an eye on that. If you're at home and watching that, kind of see how Powell's testimony goes later today and tomorrow. We'll be talking again tomorrow, and then we'll see how the market goes. I don't expect it to break out of this range that we're in here, but the big number then will be on Friday. And again, you want to see this number start to show. Hopefully we can see it fall below 250, 225. I think if we see that, we could probably get a little bit of bounce back in the market. But if we get above that 250, 275, I don't see the market, anybody jumping in here to buy equities at that level.
Anything else you want to share with our subscribers before we go?
No, I think that's about it. Actually, I expect some real volatility in here with all this numbers. But there's a lot of info to come out. And again, the week after next Friday, we get that jobs report, and then the following Tuesday and Wednesday is that FOMC meeting, and it looks now that we're leaning more towards a 0.5 point rate hike, and the market's not going to like that. I don't think you're going to see much upside. Well, that's a little bit of a headwind that I think will keep a lid on stocks going forward.
All right. Well, thank you. If anyone has questions about anything going on in the market right now, you feel free to reach out to us at support@marketedge.com or use that chat now box in the bottom right-hand corner of your screen. David, thank you so much for your time today, and we'll catch you guys next week.